In this video, we're going to look at Tanger Outlets, and this company is a REIT, and what they do is they own large shopping centers that have outlet stores in them. What I do in my videos is I run my discounted cash flow model to figure out the real value of the stock, then look at the financial ratios of the company and compare them with its competitors. I do this with you throughout the whole video, so it's like we're doing this together. Let's get started with the model. This company has a market cap of $602.9 million. It's kind of a small company. And then they're trading at $6.45. So that's one share of stock is $6.45. Now we need the free cash flows. And the way you value a company is you estimate the future free cash flows, then you discount that number back to today's value. And that's what I'm doing in the video. And we also need the net income. And net income is the profit and loss of a company, and that's on the income statement. That's the money that's left over after paying all your expenses, but before paying dividends. And as you know, REITs pay a lot of dividends. Next, we're going to pull revenue, which are the sales for each year. And we want to take a quick look at the numbers. They look pretty consistent. The net profit margins are all over the place. And net profit margins are net income over revenue. It's how well you convert revenue into profit. They have 42% in 2016, which is great. Then it drops to 14. It drops to 9. Then it doubles to 18. So a lot of things going on in there. But let's look at the capital structure of the company to figure out what discount rate to apply to the future cash flows. So they pay $62 million of interest on their debt. That's on the income statement. And let's see how much debt they have. We'll go to the balance sheet. The current debt, no current debt. Long-term debt of $1.6 billion. That's debt due after 12 months. We need the cost of equity, so let's pull the beta. The beta is how volatile the stock is relative to the entire market. They have a beta of 1.84. So the stock is a bit more volatile than the market, almost 2 times as volatile. Let's get their current assets. We need this to calculate the current ratio. And current assets are mainly cash, accounts receivables, and inventory. $120 million. That's on the balance sheet. Current liabilities is also needed for the current ratio. This is what the company owes within the next 12 months. That's $80 million. And the equity is the value of the company according to the balance sheet. That's $433 million. That's assets minus liabilities. Let's pull their EBIT, earnings before interest and taxes. On the income statement, they call that operating income, $143 million. So let's look at the capital structure. They have 78% debt, and the cost of debt is 3.9%. They have 22% equity, and the cost of equity is 16.5%. And the WACC is 6.64%. The WACC is a blend of cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows based off of prior financial information. This is the prior right here in white. We also estimated terminal value, which is all years past year 4. We discounted that number back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 93 million shares, and we get an intrinsic stock price of $18.40. It's trading at $6.45, so it's trading at a 65% discount. So it's a strong buy according to the model. Let's see what Simply Wall Street, they're even higher, they're at $24. So they're even a stronger buy. Let's look at the historical stock price to see where it's been trading at. So it was trading up into the 30s and maybe even 40s a couple of years ago, and it's been dropping ever since. I understand why it's dropping, because with coronavirus, hardly anybody's going out and shopping anymore. People are buying things on Amazon or eBay or all those online websites. So these outlet stores are probably really struggling, and I expect investors are not willing to pay $20, $30, $40 for this stock. They're driving the price down. So this could be a good value depending how long coronavirus sits in the community for and when people start coming out in droves like they were before. Let's look at the financial ratios of the company. Maybe we'll get more information. They have a really good PE, that's price of stock over earnings per share. And the price of the stock is $6.45 and the earnings per share is 94 cents. And to get earnings per share, it's net income, 88 million, divided by shares outstanding, 93 million. So they're providing a good return for this ratio. I like to see below 15. The price to sales ratio is also pretty good, 1.3. That's price of stock of $6.45 over sales per share, $5.12. And sales per share is revenue, $478 million, over shares outstanding, 93 million, $5.12. So that means investors are willing to pay $1.30 for $1 of sales. That's pretty good. I like to see under 2.5 for this ratio. Price to book of 1.4, also really good. That's price of stock, $6.45, over book value per share, $4.63. Equals 1.4. And to get to 463, it's the equity, the $433 million of equity. Remember, equity is assets minus liabilities on the balance sheet. And take that $433 million divided by the shares outstanding of 93 million, you get to 463. So this indicates if the company went bankrupt today, each shareholder would get $4.63 back. Let's look at the current ratio, 1.5. That's a good current ratio. That's current assets of 120 million over current liabilities of 80 million. So they can cover their current liabilities, which is important. ROE at 20%, which is good. That's income, 88 million, over equity, 433 million. So they can provide a good return to the equity holders. Interest coverage ratio of 2.3, that's EBIT, 144 million, over interest expense, 62 million, 2.3. So they can cover their interest expense, and debt of 78%, so they're definitely leveraged. The best way to look at ratios is to compare them to similar companies. I've done videos on Simon Property Group and Realty Income. Tanger is right here in the middle. Some analysts use funds from operations to value REITs, as opposed to using the PE, price to sales, and price to book ratios. So funds from operations is net income plus depreciation and amortization minus gains on sales of real estate. And this ratio seems to be more appropriate for REITs. And this calculation is the price of the stock over the funds from operations per share. So for this ratio, the lower the better. So Tanger Outlets is doing the best job of the three companies. Simon Property Group is doing okay, and Realty Income is not providing as good of a value for this ratio. Tanger has the best price to earnings, price to sales, and price to book ratio of the three companies. In terms of current ratio, Tanger and Realty are doing okay. Simon is 0.5, so they're a little low. Simon has the best ROE by far, 83%, so they're providing a great return to their equity holders. But Simon is really leveraged at 91% debt. So is Tanger, 78%. Realty Income is doing okay at 45%. And in terms of market cap, Tanger is tiny compared to the giants Realty Income and Simon Property Group. So let me know what you think of the video. Thanks for watching.